Most traders stare at the price chart, looking for patterns and drawing lines. But price is simply the advertisement. Volume is the actual transaction. It's the proof of what's really happening behind every single move. To read volume correctly, you only need one mental model: effort versus result. Think of pushing a car uphill. Your foot on the gas pedal is the effort, the volume. How far the car moves is the result, the price candle. If you press the gas and the car moves easily, your heavy effort gets a matching result. On a chart, this looks like a large, full candlestick paired with a tall volume bar right underneath it. When the amount of money pushing the market perfectly matches how far the price travels, the move is healthy. Lots of buyers, lots of conviction, and a genuine trend you can trust. Before we go deeper, we need to fix the most common mistake in trading. A green volume bar does not mean buying, and a red bar does not mean selling. Every single trade requires both a buyer and a seller. To read volume properly, you need to erase those colors from your mind. The color of the bar is simply copying the candle above it. The real story comes from looking strictly at the size of the volume bar, combined with where the candle closes. This brings us to what happens when effort and result disagree. Imagine the market is crashing. Suddenly, you see a massive spike in volume, huge effort, but the candle doesn't drop further. Instead, it forms a long wick and closes near the middle. This is called absorption, or stopping volume. Retail traders are panic selling, but someone with deep pockets is sitting at a key support level, quietly buying everything up. They are stopping the crash with sheer capital. The exact opposite happens at the top of a long uptrend. You see a huge green candle on the highest volume of the month. Retail traders rush in, afraid to miss out. But smart money is actually using that wall of incoming buy orders to unload their massive positions, quietly selling right into the excitement. Extreme volume after a long trend is rarely a sign of strength. It's the footprint of large institutions rotating positions, signaling an impending reversal. If extreme volume signals a sudden reversal, declining volume gives you a slow motion warning. This is called volume divergence. Watch what happens here, as price makes higher highs, but the volume bars get smaller and smaller. The trend looks healthy on the surface, but fewer and fewer traders are actually participating. Like a rocket burning through the last of its fuel, the upward momentum is surviving on fumes. To spot these traps before they happen, use a 3-step volume check. First, zoom out to check the overall volume climate. Second, zoom in to key support and resistance levels to test effort versus result. And third, wait for the next candle to confirm the move. Let's test this. Price pushes up into a major resistance line. The volume spikes massively, but the candle that forms is a tiny doji with a long upper wick. What is happening here? That is absorption. High effort, tiny result. The resistance wall is holding, and recognizing that anomaly protects you from buying into an institutional trap. Let's put the entire system together on a live chart simulation. Price approaches resistance, and this time it breaks through with a large green candle on high volume. The effort matches the result. It's a valid breakout. Instead of jumping in immediately, we wait for confirmation. Price pulls back to test the broken level. The candle is small, and the volume drops to almost nothing. This is a no-supply test. It proves the sellers are completely absent, giving you a safe, calculated entry point. The trade moves in your favor, steadily making new highs. But look at the bottom of the chart. The volume bars are steadily sloping downwards. The move is losing participation. Suddenly, a massive green candle prints on extreme, chart-topping volume. You know exactly what this is: a buying climax. The retail crowd is rushing in, making it the perfect moment for you to exit your position right alongside the smart money. Before you place your next trade, run through this 5-point checklist. Check the overall trend. Make sure effort matches result. Look for absorption at key levels. Watch for divergence, and wait for a low volume confirmation. Price can be manipulated, but volume shows you where the real money is stepping in. When you wait for proof through this checklist, you stop gambling and start